There is a moment in every major storm where the navigator has to stop looking at the waves crashing over the bow and start looking at the compass. For the last few days, we have been staring at the waves. We have been staring at red candles that felt like waterfalls and green candles that felt like rocket launches. We've been battered by headlines, whipsawed by volatility, and gaslighted by a financial media that treats a structural currency crisis like a sporting event. But now, as the dust begins to settle on one of the most chaotic weeks in the history of the silver market, it is time to look at the compass. It is time to ask the hard question: was this a freak accident? Was this a black swan that we can shrug off? Or was this something else? Was this the sound of the gears of the global financial machine grinding, stripping, and finally resetting? I believe we are living through a silver reset. This is not a term I use lightly. A reset is not a correction. A correction is a pause in a trend. A reset is a change in the nature of the trend itself. It is a shift from one regime to another. We are moving from a regime where silver was priced as a forgotten industrial commodity to a regime where silver is being priced as a strategic monetary asset in a world that is running out of trust. And the violence we just witnessed, the crash, the panic, the surge, is simply the friction of that transition. It is the sound of the old pricing model breaking down and a new one trying to be born. To navigate this new world, we have to throw away the old maps. The analysts on CNBC are telling you that what happened was a 10 sigma event. That is statistical speak for impossible. They are saying that mathematically, a move of this magnitude should only happen once every million years. But here we are. It happened. And it will happen again. Why? Because their models are broken. They are using a normal distribution, a bell curve, to model a market that is anything but normal. They are assuming that silver behaves like a gentle stream, when in reality silver behaves like a dormant volcano. It does nothing for years, and then it explodes. If your model says that reality is impossible, then your model is wrong. We need a new model. We need a model that accounts for fat tails. We need a model that understands that in a leveraged, manipulated, and physically scarce market, extreme events are not anomalies. They are features. They are the release valves for a system that is under immense pressure. When you compress a spring for 40 years, suppressing the price of silver through paper derivatives, you cannot expect the release to be gentle. You must expect violence. You must expect chaos, and you must not be shaken by it. The mistake most investors made this week was assuming that the volatility was a signal of weakness. They saw the price drop and thought, the demand is gone. They saw the price rip and thought, the shorts are dead. Both were wrong. The volatility is not a directional signal, it is a structural signal. It is telling us that the liquidity in the market is thin. It is telling us that the leverage is high. It is telling us that the participants are nervous, but it is not telling us anything about the fundamental value of an ounce of silver. Let's break down the mechanics of the reset. It starts with a crowded trade. Everyone sees the breakout. Everyone piles in. The open interest explodes. This is the fuel. Then a spark hits. Maybe it's a margin hike. Maybe it's a headline about the Fed. Maybe it's a rumor from China. The spark ignites the fuel. The selling starts. But in a leveraged market, selling begets selling. The price drops, triggering margin calls. Traders are forced to sell to cover their debts. This pushes the price lower, triggering more margin calls. It is a feedback loop, a doom loop. This is why the crash was so vertical. It wasn't a debate between buyers and sellers. It was a liquidation. It was a fire sale. But here's the key. Once the forced selling is over, once the insolvent traders are washed out, the selling pressure vanishes instantly. There is nobody left to sell. And so, the price snaps back. It rebounds with the same violence that it fell. This is the V-shaped recovery we are seeing. It is mechanical, it is predictable, and yet it catches people off guard every single time because they are reacting to the price, not the structure. We must stop treating volatility as an enemy. In the world of precious metals, volatility is the price of admission. It is the toll you pay to ride the rocket. If you want a smooth ride, go buy a treasury bond and watch your purchasing power slowly die. If you want to preserve your wealth and potentially multiply it, you have to accept the jagged line. You have to accept that your net worth will swing wildly from day to day. But you must also understand that these swings are happening around a trend that is pointing relentlessly higher. The trend is driven by forces that no algorithm can trade away. It is driven by the fact that the United States government is adding $1 trillion of debt every 100 days. It is driven by the fact that the green energy transition requires more silver than we can mine. It is driven by the fact that the geopolitical order is fracturing and nations are hoarding real assets. These are the anchors. These are the constants. The price is the variable. The price fluctuates. The anchors hold. Let's talk about the 5 anchors that kept the smart money sane this week. While the tourists were panicking, the veterans were checking these 5 things. First, the structural balance. Is the world still in a silver deficit? Yes. The Silver Institute data, the mining reports, the industrial offtake numbers, they all confirm that we are consuming more than we produce. The deficit is not gone because the price dropped. If anything, the lower price stimulates more consumption, making the deficit worse. The anchor holds. Second, the buyer mix. Who is buying? Is it just retail speculators? No. It is central banks. It is family offices. It is industrial giants. This is high-quality buying. Speculators sell when they get scared. Strategic buyers buy more when the price drops. The fact that premiums stayed high during the crash proves that the strategic buyers were active. The anchor holds. Third, the term structure. This is a fancy way of looking at the futures curve. Is the market in backwardation? Are traders paying more for silver today than for silver next month? We saw signs of backwardation during the crash. This is the market screaming for immediate physical delivery. It is a sign of extreme tightness. In a bear market, you see contango, where future prices are higher because there is plenty of supply. We are seeing the opposite. The anchor holds. Fourth, the monetary background. Did the Fed solve the debt crisis this week? Did inflation disappear? No. The monetary debasement continues. The printing press is still the only tool they have. The dollar may have rallied for a few days, but the long-term trajectory of the dollar is down. It has lost 98% of its value since the Fed was created. It will lose the remaining 2%. The anchor holds. Fifth, the volatility regime. Are we in a period of calm or a period of chaos? We are in chaos, and historically, the biggest moves in silver happen during periods of chaos. Volatility is not a sign of a top, it is a sign of a repricing. When an asset is moving from one valuation tier to another, say from $30 to $50, it rarely goes in a straight line. It thrashes, it shakes, it tests the resolve of the holders. We are in the rapids, not the lake. The anchor holds. If you looked at these 5 anchors on Monday, you would have seen that the thesis was intact. You would have seen that the sell-off was an opportunity, not a threat. But it is hard to look at anchors when the ship is listing. It requires discipline. It requires a separation of emotion and logic. It requires you to be a cold-blooded operator in a hot-blooded market. We also need to discuss the hidden accelerator of the options market. This is a technical factor that exacerbated the moves this week. When you buy a call option on silver, the bank that sold it to you has to hedge. They have to buy a little bit of silver futures to protect themselves. As the price goes up, they have to buy more. This is called gamma hedging. It creates a buying spiral, but it works in reverse too. When the price starts to fall, the banks have to sell their hedges. They become forced sellers. This creates a market that overshoots in both directions. It goes too high and it goes too low. The price you see on the screen is often a reflection of dealer gamma rather than true supply and demand. Understanding this helps you stay calm. You realize that the price action is artificial. It is a derivative of a derivative. It is a shadow on the wall, not the monster itself. The danger in this market is not that the price goes down. The danger is that the price goes nowhere. If the volatility died, if the volume dried up, if everyone stopped talking about silver, that would be a bearish signal. That would mean the energy has left the market. But we are seeing the opposite. We are seeing record volume. We are seeing record engagement. We are seeing passion. Love it or hate it, the world is watching silver right now. And attention is the precursor to liquidity. When capital starts to pay attention to an asset class that is this small, explosive things happen. The silver market is tiny. You could fit the entire annual production of silver into a single large room. If a fraction of the money sitting in the bond market or the tech stocks decides to move into silver, there is no door big enough to let them in. They will have to bid the price up to the moon just to get a seat at the table. This is the reset we are waiting for. The moment when silver is no longer priced by the marginal cost of production, but by the marginal utility of its monetary role. We are moving from commodity pricing to monetary pricing. In commodity pricing, silver trades near its mining cost. In monetary pricing, silver trades at a multiple of its mining cost, reflecting its premium as a store of value. Gold has traded at a monetary premium for decades. Silver is just starting to reclaim its monetary heritage. The banks know this is coming. That is why they are so aggressive. They are fighting a rearguard action. They are trying to delay the inevitable, but they are losing control. The smash they engineered on Monday was a desperate move. It showed their hand. It showed that they are terrified of the price running away from them. If they were confident, they would have let it drift. The violence of their reaction is proof of the fragility of their position. And let's be clear, the bankers' smash may not hold. In the past, they could smash the price and keep it down for months. But this time, the rebound was almost immediate. The buyers stepped in too fast. The physical demand was too strong. This suggests that the buy the dip mentality has become entrenched. The psychological conditioning of the last decade, where every dip was a trap, has been broken. Investors now see the dip as a gift. This change in psychology is fatal for the shorts. If they cannot scare you, they cannot win. So, what happens next? If the smash fails to hold, we enter a short squeeze dynamic. The shorts who piled in on Monday expecting a collapse are now trapped. As the price rises, they are underwater. They have to buy to cover. Their buying drives the price higher, squeezing the next layer of shorts. It is the reverse of the liquidation cascade. It is an accumulation cascade, and it can take the price to new highs very, very quickly. But do not get complacent. The chop will continue. We will see days where silver is down 5% for no reason. We will see days where it is up 5% for no reason. This is the new normal. You have to numb yourself to it. You have to stop checking your portfolio every hour. You have to extend your time horizon. Are you investing for next week or for the next decade? If you are investing for the next decade, this week was a blip. It was a noise. It was a buying opportunity, nothing more. The fundamental story, the exhaustion of the mines, the explosion of debt, the fracturing of the world takes years to play out. You have to give it room to breathe. You have to let the cake bake. If you keep opening the oven door to check on it, it will collapse. The reset is also about a reset in your mindset. You have to stop thinking in dollars. The dollar is the measuring stick, but the stick is shrinking. If silver goes to $100, but a loaf of bread goes to $20, have you gained wealth or have you just preserved it? The goal of stacking silver is not to get more dollars. It is to get more purchasing power. It is to carry value through the fire of inflation. When you look at silver this way, the volatility becomes irrelevant. An ounce is an ounce. It buys you the same amount of bread or more, regardless of what the dollar price says. The dollar price is just a hallucination of the central bank. The ounce is the reality of the earth. As we move forward, watch the spread, watch the premiums, watch the inventory levels. These are the real indicators. If the inventory at the COMEX keeps dropping, the price has to rise. It is physics. You cannot have a market with no product. Eventually, the price has to rise high enough to incentivize holders to sell. And right now, the holders are not selling. They are digging in. The final warning is not about selling. It is about understanding the stakes. We are playing for all the marbles. We are playing for the future of money. The old system is dying. It is lashing out in its death throes. That is what the volatility is. It is the death rattle of the fiat regime. Do not be afraid of it. Be prepared for it. Embrace the chaos. Chaos is the ladder to higher prices, the ladder to freedom, the ladder to a world where honest money reigns supreme. So when you see the next smash, and there will be another one, do not panic. Smile. Know that it is just the machine resetting. Know that it is just the weak hands leaving. Know that it is just an opportunity to grab another rung on the ladder. The silver reset is here. It is messy. It is loud. It is scary. But it is real. And it is the most exciting opportunity in the world right now. Do not let them shake you out. Do not let them steal your seat. Hold fast. The ride is just beginning. Think about the sheer scale of the deception we have lived under. For 50 years, we have been told that paper is money and gold is a rock. We have been told that debt is wealth and saving is foolish. We have been told that the government can solve every problem by printing more currency. This entire edifice of lies is crumbling. The cracks are visible. The silver market is just one of the cracks, but it is the one where the light is shining through most brightly. The violence of the price action is the system trying to patch the cracks. It is the system trying to force reality back into the box. But reality is too big. The debt is too big. The demand is too big. The box is breaking. You are standing outside the box. You are holding the metal. You are safe. But you have to keep your nerve. You have to trust your analysis. You have to trust history. History tells us that every fiat currency eventually returns to its intrinsic value, zero. History tells us that gold and silver have survived every empire, every war, every collapse. They will survive this one too. The reset is not something to fear. It is something to welcome. It is the restoration of sanity. It is the return of balance. It is the victory of the real over the fake. So as we watch the charts whip around, remember what you hold. You hold history. You hold energy. You hold truth. No algorithm can take that away from you. No central banker can print it away from you. It is yours. The storm will pass, the volatility will subside, and when it does, silver will be standing on higher ground, and you will be standing there with it. Stay strong, stay focused, stay stacked. The silver reset is the story of our time, and you are the protagonist. Write a good ending. Write an ending where you didn't sell. Write an ending where you held the line. Write an ending where you won.